I'm Steven from You Should Be Investing, and today I'm going to look at 3 emerging market ETFs that you should consider in 2019. Emerging market funds that focus on stocks from countries like China, India, and Brazil are often overlooked by individual investors who prefer the safe waters of American and European stocks. But while emerging markets do have more risk and volatility, they are an important part of any diversified portfolio and can offer the potential for higher returns. The Vanguard FTSE Emerging Market Fund is the most popular emerging market ETF with over $66 billion in assets under management. The fund closely tracks the FTSE Emerging Market Index and is comprised of over 4,700 different stocks. VWO has a low expense ratio of 0.12 and keeps its turnover relatively low at 10.8%. 2/3 of the fund is comprised of companies from China, Taiwan, India, and Brazil, and it's heavily concentrated in the financials and technology sectors. The Chinese juggernauts Tencent and Alibaba together make up about 8.5% of the fund, and Taiwan Semiconductor is the only other company to break 2%. Emerging markets had a rough ride in 2018 after banner years in 16 and 17, and VWO fluctuated accordingly. It reached a high of about $51 a share in January 2018 before eventually falling to a low of $36.35 in October. It's had a strong rally in early 2019, reaching as high as $44 a share, but it still has a way to go to match its all-time high. VWO's popularity means it's very easy to trade. There will always be buyers and sellers available. It's also extremely diversified, diving deeper into the pool of small and microcap stocks than many other funds. In fact, it has more than twice the holdings of our next ETF, IEMG. The iShares MSCI Core Emerging Markets ETF is another great choice for investors in 2019. IEMG is currently the second most popular emerging market ETF, with $61.1 billion under management. The biggest difference between IEMG and VWO is that IEMG tracks a different index, the MSCI index, which includes South Korea as an emerging market. In fact, South Korean companies make up over 13% of the iShares fund, second only to Chinese companies. Like VWO, IEMG is concentrated in the tech and financial sectors, with Tencent, Alibaba, and Taiwan Semiconductor its largest holdings. Korea-based Samsung joins these three as the only companies comprising more than 2% of the fund. Overall, IEMG has about 2,200 different holdings. The fund has an expense ratio of 0.14 with a very low turnover of 6%. Like VWO, IEMG peaked in January 2018, reaching a price of over $62 a share. It fell to as low as $45.35 in October before rallying to its current price over $53 a share. IEMG is a fairly new fund, started only in 2012. iShares also offers another broad emerging markets ETF, the iShares MSCI Emerging Markets ETF, or EEM, that has been around since 2003. EEM covers the same countries and its top holdings are identical to IEMG's, yet EEM is inferior to IEMG in almost every way. It has a much higher expense ratio of 0.67 and has less than half the number of holdings, owning very few small and micro-cap stocks. These factors have contributed to EEM performing worse than IEMG over the last 1, 3, and 5 years by as much as 0.4% a year. Another great option for investors in 2019 is the Schwab Emerging Markets Equity ETF, SCHE. Created in 2010, SCHE follows the same index as Vanguard's VWO, which means it does not include equities from South Korea. Since it tracks the same index as VWO, SCHE's portfolio is very similar. The biggest difference is that the Schwab fund only has about 1,000 holdings, which is still quite diversified, but does mean its portfolio is more heavily concentrated in the biggest companies, with Tencent and Alibaba together comprising over 10% of the portfolio. SCHE has had a rough 12 months, but has actually performed better than many of its peers over that time frame. It reached a high of $31 a share in early 2018 before falling to a low of $22.82. It currently trades for about $27 a share. Though SCHE isn't as popular as VWO or IEMG, with only $6 billion in total assets, its low expense ratio of 0.13 and its comparable performance make it another great option for investors. In fact, SCHE has actually outperformed both VWO and IEMG over the last 1, 3, and 5 years. All three of these emerging market ETFs have similar expense ratios, over 1,000 holdings, and billions in total net assets. With the exception of the South Korean stocks in IEMG's portfolio, they cover the same countries and have the same top holdings. Their performance over the last few years is also very similar, with the smaller Schwab fund barely winning out. As you can tell from these numbers, emerging markets can take you on a bit of a roller coaster ride, but if you stay the course and resist the urge to sell low, they can play an important role in every portfolio, providing a lot of good diversification. As always, make sure to do your own research and due diligence before making any type of investment. But if you do decide to invest in emerging markets in 2019, any of these three funds would be a solid choice.